Hello, today we're going to talk about the psychological traps that investors often fall into and how to avoid them. Investing isn't just about financial analysis. Emotional factors play a huge role too. Many times, it's not the market conditions that cause losses but emotional decisions. Today, we'll look at 5 common psychological traps in investing and how we can avoid them. 1. Greed and taking excessive risks. When investing, greed is one of the biggest enemies. Especially when there are high-profit opportunities in the market, it can be tempting to take huge risks. However, the key here is to stay rational and choose balanced risks rather than going after extreme opportunities. Greed often leads investors to take on risks that exceed their tolerance levels, making investments that are not based on thorough research. Over time, this can result in significant losses. It's essential to be patient, do proper research, and spread your risks in a balanced manner. A good way to assess this is by asking yourself whether you're comfortable losing the amount you're about to invest. If you're not comfortable with the potential loss, it might be a sign that this investment isn't right for you. 2. Overestimating your own success. Many investors, after a few successful trades, start thinking they're experts. But in reality, a few successful moves don't guarantee ongoing success. Overestimating one's success can lead to poor decisions in the future. In the fast-changing world of investing, past success doesn't guarantee future results. While success is important, it's also important not to let it create overconfidence. When investing, it's important to remain calm and evaluate each opportunity objectively. Every investor has different risk levels, and sometimes the best strategy is a cautious and long-term approach. 3. Fear and panic selling. Markets are volatile, and during downturns, fear can set in. This fear can cause investors to panic and make rash decisions, like selling their investments in a hurry. But making decisions based on fear can often lead to bigger losses. For example, if you sell your stocks just because they're losing value, it might seem like you're minimizing losses in the short term, but in the long run, you may miss out on opportunities for recovery. Panic selling can cause you to lock in losses rather than letting your investments recover. The key here is to be prepared for market fluctuations and stay calm. Instead of focusing on short-term changes, keep your long-term goals in mind and avoid making emotional decisions in response to market volatility. 4. Herd mentality. A lot of investors tend to follow the crowd, especially when there's a lot of buzz about a particular stock or investment. The "everyone is buying, so I should buy too" mentality can lead to poor investment choices. Every investor has a different risk profile. What works for others might not be suitable for you. Avoiding herd mentality means you need to base your decisions on your own research and financial goals, rather than following what others are doing. To avoid this, evaluate each investment opportunity based on your own circumstances. Don't focus on what others are doing. Instead, focus on what works best for you in the long run. 5. Loss aversion. One of the most common psychological traps is loss aversion. People are generally more fearful of losses than they are motivated by potential gains. This fear can sometimes lead investors to make irrational decisions in an attempt to recover their losses. Loss aversion can cause an investor to hold on to a losing stock, hoping it will bounce back, even when it's clear that it's unlikely to recover. This loss-chasing mindset can end up deepening the losses instead of cutting them early and moving on. The key is to accept losses as part of investing. Being emotionally prepared to handle losses and knowing when to stop the bleeding is crucial. Using stop-loss strategies can help you limit losses and prevent them from escalating. Investing is not just about numbers. It's also about managing your emotions. Greed, overconfidence, fear, herd mentality, and loss aversion are all psychological traps that can lead to poor decisions. To avoid these traps, it's essential to stay calm, make rational decisions, and focus on long-term goals. By being mindful of these psychological factors, you can make better investment decisions and avoid the emotional pitfalls that lead to losses. Stay objective and strategic in your approach, and over time, you'll increase your chances of success in the investment world.